Now, the U.S. equity markets had a great October. Our next guest says there's plenty of room left in the bull market. He believes the S&P 500 can tack on another 400 points. Joining us from New York is Ross Gibbons. He's the chief market analyst for the investment advisory service Wealth Empire and the 13F Insider. Ross, 400 points, that's a big number given where we are. What's the time frame? Let's start with that.
Well, thanks for having me on, first of all. And I'm thinking by the end of 2016, we could actually achieve that number. You know, a lot of people are writing off 2016 as a really lackluster performance as far as expectation goes. I think we're going to blow them away.
You have a couple of positive factors you're looking at, and I'm just reading here, a CEO buy-sell ratio. You're looking at the valuation, which you say is a positive factor. Some people put that as a negative. Let's focus in on the valuation factor at 17 times, give or take. You put that under the positive category.
I did, and a lot of people miss this. You know, it's really easy to look back at history and say, well, the market normally trades at 14, 15 times, 16 times, so 17's too high. But the part they're missing is, you know, when you look back at the last time we traded at these multiples, we were in a 4, 5, 6% interest rate environment, and now we're in a 0% environment. You know, you take a 17 times earnings and divide that out. Stocks are yielding, you know, about 6% on earnings, right? Where else can you get a 6% yield? You know, Canadian 10-year notes are yielding about 1.6, U.S. notes about 2%, government bond or corporate bonds maybe 2.5, 3%, maybe 4% for junk. You know, it's plenty adequate and it's strong compared to your alternatives, and I think that's what everyone's missing.
And it is all about the alternatives. What about the CEO buy-sell ratio?
Well, one thing you can track, you know, CEOs, obviously their actions have a lot of weight, and so they have to report anytime they buy or sell their own company's stock with their own money. Now, you know, a lot of their compensation is issued in stock, right? We know that. So they could sell stock for any number of reasons. They want to, you know, add a 12th bedroom to their house or send a kid to college, you know, whatever that may be. But when they buy their own stock with their own money, there's only one reason to do that, and that's because you think shares are going higher. And it's only happened 3 times in the last decade. Once was at the end of 08, early 09. Once was August, September 11, that one little blip we had in the S&P in this bull market. And the third time was August of this year. You know, and these are men and women that have a fantastic track record of timing the market. And I put a lot of weight to their actions.
Ross, I used that very same phrase yesterday. You sell for a whole pile of reasons, but you only buy for one. That's because you think the stock's going to go up.
That's right.
That's a great phrase. I'm going to use it again and again because I love it. Let's talk about where you want to be. And a couple of sectors and names stand out. So we'll start with autos because we are getting the auto sales for the month of October. You like General Motors, and indeed, General Motors had a pretty decent October. Car sales have actually been pretty decent right across the board.
Yeah, I mean, things look good for autos, obviously, right? I mean, it seems the economy tends to lag the market just a bit. So people who are buying new automobiles, especially higher-end luxury cars, you know, a lot of their activities are based on, their buying activities are based on the market. It's the same thing with fine art and other kind of luxury goods. So, you know, when the market's up and things are strong, that generally is a positive for the automotive buying market. And you look at a stock like General Motors, you know, look, the thing's trading for $35, $36 a share. They're on pace to do $5 a share in earnings this year, $5.25 next. So it's trading at, what, 7 times forward earnings? I mean, it's insanely low for a stock of this quality, and it could easily be a double in 2016. That's why I'm long the stock and actually levered long the stock.
I've been caught in the auto stocks are cheap trap, let me call it that, in the past. Sometimes these names trade cheap when the sector's just about to roll over.
No, you make a good point. Now, I would definitely caution people to do that. You know, if we're looking at, look, if this thing's trading at 13 or 14 times earnings when the market's at 16 or 17, you know, not worth it. Because you're right. I mean, people who had this as buy and hold forever, last time they lost everything with GM, right? But, you know, 7 times as a multiple is just insanely low. It's less than half the market. You know, even if it does half of what I think it will, you're talking about a 50% upside from this stock. It's got a lot of negative sentiment around it since the bankruptcy back in '09. Last year was kind of the year of the recall. They had a record number of recalls, and so investors are a little bit scared on this. But I do think the valuation, even if it doesn't catch up with the general market, is going to be a lot higher than 7 times, and that's going to equate to a really nice move up in the stock.
Ross, you also like Exxon. Nobody likes oil. What's your problem?
Well, that's the reason I like it, is because no one likes it. You know, what do they say? When there's blood on the street, buy real estate. You know, one of the best ways to underperform the markets is to do exactly what everyone else is doing. You have to be tactical and identify good opportunities when no one else sees them. And because that no one likes it, and because it's so undersold, and because crude prices are so cheap right now, that's exactly what makes it such a strong investment. And, you know, you look at guys like Carl Icahn, one of the greatest hedge fund managers of all time. He just bought a huge stake in Cheniere Energy. A lot of these guys are loading up on it because they know, look, you can't predict the next month or quarter or even year, but long term, crude's not going to stay at $45 a barrel. You know, we're going to return to $80, $100, $120 a barrel oil. These guys are going to see their profits increase dramatically, and in hindsight, it's going to be viewed as a great time to get into the energy space.
You mentioned Carl Icahn, one of his favorite names, Apple. And you like Apple as well. It started to actually pick up a little bit of steam here in the last month with the market, but it's underperforming some of its big peers like Amazon and Google. You like Apple?
Love Apple. I mean, I couldn't like Apple anymore. You know, this is another stock that I own personally. Look, it's the largest company in the world. They've continued to shock the market and continue to grow earnings. They've got an ecosystem. You know, ask anyone with an iPhone, an iPad, you can't pry the thing out of their hands because their customer loyalty is so much stronger than anyone in that market. And the more products they add, the Apple TV is now a real contender in that space. The tablets, the phones, the watch. I mean, I'm wearing one right now. Once you get into that ecosystem, it's really hard to get out. And on top of that, you look from a valuation standpoint, you've got this phenomenal company with $200 billion in cash, and they're trading at 11 times forward earnings. You know, the stock got down to the 90s with that August pullback, and it's already back to 120 or so. I think the stock's worth 160, 170. I think we'll see $200 a share and the first trillion-dollar market cap company in the history of the world by the end of next year, early 2017.
Ross Givens, what a pleasure to talk to you. Thank you very much for joining us today.
Oh, thanks so much. My pleasure for having me on.
Great. Ross Givens, Chief Market Analyst for the investment advisory service Wealth Empire and the 13F Insider. 13F's, just by the way, 45 days after the end of the quarter. That's going to be coming up. We might get Ross on when we talk about 13Fs.